Will AI replace accountants? That question has been asked in boardrooms, classrooms, comment sections, and late-night conversations between professionals who are trying to understand what the next decade might look like. It usually comes with a mix of curiosity and quiet anxiety, because accounting, for many people, represents something stable, structured, rule-based. If artificial intelligence is going to replace anyone, the logic goes, surely it starts there. But before we rush to conclusions, it's worth slowing down and asking a more precise question. Not can AI do accounting tasks, but what does accounting actually consist of in the real world, and where does AI truly fit into that picture? Because once you separate perception from reality, the answer becomes far less dramatic and far more useful. I want to ground this discussion in what accounting actually looks like on the ground. Not the abstract version you see in headlines or software demos, but the lived reality of how businesses operate, how financial decisions are made, and how risk is managed. Over the past decade, accounting has already changed significantly. Cloud software, automation, standardized reporting, and regulatory digitization have reshaped the profession long before generative AI entered the conversation. Many routine tasks that once required hours of manual effort are now handled by systems quietly in the background. And yet, accountants are still here. In many cases, they are more in demand than before. That contradiction is the starting point for understanding what is really happening. To make sense of this, we need a simple framework, one mental model that can guide the entire conversation. Think of accounting not as a single job, but as three distinct layers of work. The first layer is mechanical execution: data entry, classification, reconciliation, and standardized calculations. The second layer is judgment and interpretation: applying rules to messy realities, making estimates, exercising professional skepticism, and explaining financial outcomes. The third layer is accountability and trust: legal responsibility, ethical duty, client relationships, and institutional credibility. AI interacts with each of these layers very differently, and most confusion comes from assuming that progress in the first layer automatically replaces the other two. Let's start with the mechanical layer, because this is where AI's capabilities are most visible and easiest to misunderstand. Modern accounting software already automates a large portion of transactional work. Bank feeds import transactions automatically, rules categorize expenses, invoices are scanned and recognized using optical character recognition. Reconciliations that once took days can now be completed in minutes. AI improves this layer by reducing errors, speeding up classification, and handling larger volumes of data without fatigue. From a purely technical standpoint, yes, machines are better than humans at repetitive, rule-based tasks. This is not new and it is not controversial, but even here the reality is more constrained than people assume. Real-world data is messy, vendors change names, don't match cleanly, systems fail, exceptions pile up. Someone has to decide whether a payment is an expense, an asset, or a prepaid item. Someone has to investigate discrepancies, resolve ambiguities, and correct upstream errors. AI can assist, but it still operates within the boundaries of the data it is given and the rules it has been trained on. It does not understand the business context in the way a human does. It predicts based on patterns. When patterns break, humans step in. Now move up to the second layer, judgment and interpretation. This is where accounting stops being clerical and starts being professional. Financial reporting is full of estimates, depreciation methods, revenue recognition timing, impairment assessments, provisions, tax positions. These are not mechanical outputs. They require interpretation of standards, understanding of business models, and informed assumptions about the future. Two competent accountants can look at the same facts and reasonably arrive at different conclusions, as long as both are defensible. AI, by design, seeks the most statistically likely answer, but professional accounting often requires choosing between multiple acceptable options based on intent, risk tolerance, and regulatory posture. Consider a practical example. A company signs a complex multi-year contract with bundled services, performance obligations, and variable consideration. Revenue recognition standards provide a framework, but applying that framework requires understanding what the customer is actually paying for, how delivery will occur, and what uncertainties exist. An AI system can summarize the standard. It can flag relevant clauses. It can even suggest a treatment based on similar contracts. But the final judgment, what management asserts, what auditors challenge, and what regulators accept, rests on human reasoning and accountability. This brings us to the third layer, accountability and trust. This is the layer most often ignored in AI will replace accountants, narratives. Accounting exists because societies need trusted financial information. Investors rely on it. Governments tax based on it. Lenders extend credit because of it. When something goes wrong, someone must be responsible, not a system, not an algorithm, a person or a firm with legal standing, ethical obligations, and reputational risk. AI cannot sign an audit opinion. It cannot be cross-examined in court. It cannot lose a professional license. These constraints are not technical limitations. They are structural features of how economic trust is maintained. Before we go further, it's important to pause on a subtle point. None of this means that accountants are immune to change. They are not. Roles will evolve, skill sets will shift, certain entry-level tasks will continue to shrink. But replacement is not the same as transformation, and this is where many assumptions break down. People imagine a clean substitution, software in, humans out. That model fits factory automation far better than it fits professional services, where outputs are embedded in legal, social, and institutional frameworks. Let's address some of the most common counter-arguments. An argument goes like this: accounting rules are codified so AI can learn them. Once AI learns them, it can apply them more consistently than humans. Therefore, accountants become unnecessary. This argument sounds logical, but it overlooks how rules function in practice. Accounting standards are principles-based, not purely rules-based. They intentionally leave room for interpretation because business reality is too diverse to be fully prescribed. Consistency is not always the goal. Faithful representation is. And faithful representation often requires nuance, context, and professional judgment. Another argument is economic. If AI can do the work cheaper, firms will be forced to adopt it, regardless of professional resistance. There is truth here, but it cuts both ways. Firms adopt technology to increase margins and scale, not to eliminate value. When automation reduces the cost of basic services, firms do not disappear. They reallocate effort toward higher value work. We have already seen this with bookkeeping and payroll. As software automated routine processing, accountants moved toward advisory, compliance strategy, and analysis. The market did not collapse, it segmented. A stronger counterargument points to generative AI's ability to explain, summarize, and converse. If AI can explain financial results to management, draft reports, and answer client questions, doesn't that encroach directly on the accountant's role? It does, but as augmentation, not replacement. These tools change how work is done, not who is responsible for it. An AI can draft a memo faster. It can generate multiple scenarios. But someone must review, validate, and stand behind that output. In regulated environments, assistance does not remove accountability. It increases the need for oversight. To understand why this distinction matters, zoom out to the broader economic context. Professional services exist at the intersection of expertise, trust, and liability. Markets reward efficiency, but they also punish failure. When financial reporting fails, consequences follow: restatements, fines, lawsuits, loss of investor confidence. Organizations are risk-averse in these areas for a reason. They will adopt AI where it reduces risk and cost, but they will retain human professionals where risk cannot be fully externalized to a system. There is also a labor market dynamic at play. Fewer people are entering the accounting profession in many countries, while regulatory complexity continues to increase. This creates a demand gap. AI in this context is less a replacement tool and more a pressure valve. It allows existing professionals to handle more complexity with fewer resources. That does not eliminate the profession, it makes it more sustainable. Now let's reframe the perception versus reality gap. The popular narrative often assumes a binary future. Either AI takes over or humans resist and fall behind. Reality is more incremental and more adaptive. Accounting has always been shaped by technology. From ledgers to spreadsheets also created anxiety, and each time the profession adjusted by moving up the value chain. What is different now is the speed of change and the visibility of AI's outputs. That makes the shift feel more abrupt, even if the underlying pattern is familiar. This is where clarity matters more than certainty. No one can predict the exact configuration of accounting roles 10 or 20 years from now, but we can say with confidence that the profession will not disappear overnight, nor will it remain static. The most realistic outcome is a redefinition of what it means to be an accountant. Less time spent on mechanical tasks, more time spent on interpretation, oversight, communication, and strategic insight. In other words, the layers that are hardest to automate become more central, not less. For individuals watching this and wondering what it means for their own careers, the takeaway is not to compete with AI on speed or volume. That is a losing game. The leverage comes from understanding how to use these tools while strengthening the human skills they cannot replace: judgment, ethical reasoning, contextual understanding, and the ability to explain complex financial realities to non-experts. Those skills have always mattered. AI simply makes that fact more visible. So will AI replace accountants? If by replace we mean eliminate the need for human professionals responsible for financial truth, accountability, and trust, the evidence points to no. If by replace we mean change how accounting work is performed and which skills are most valuable, the answer is already yes. That distinction is not comforting hype, nor is it alarmist fear. It is a realistic assessment of how technology integrates into professional systems. Before we end, it's worth returning to the original fear that drives this question. Fear thrives in uncertainty, especially when headlines oversimplify complex transitions. A clearer mental model reduces that anxiety. Accounting is not a monolithic task waiting to be automated away. It is a layered profession embedded in legal, economic, and social structures. AI reshapes the lower layers, assists in the middle, and leaves the top fundamentally human. If you're thinking about this topic, you're not alone. And if you're unsure where things are heading, that uncertainty is reasonable. The goal is not to predict a single outcome, but to understand the forces at work well enough to respond intelligently. If you found this breakdown useful, I'd be interested in hearing your perspective. Do you see AI changing your field in similar ways? Are there aspects of this conversation you think are missing? Let's continue the discussion.